What I'm going to start with is 2 bond problems, and let me make a comment on one of them before you get started. So this first one here, what I want you to think about, so I'm going to sort of give you a guided tour through the first one. And when we do the practice problems at the end of class, there's another problem that's basically the same problem with different numbers. So what I want you to think about with this first problem is you buy it. It's a 10-year bond. So you buy it at time 10. So we're going to draw a picture right here of you. Here you are. You're buying this bond. And when you buy it, you have 10 years before you receive it, the $10,000. It's a 0 coupon bond. And you have an 8% yield to maturity. So basic cash flow problem. Now what happens is you hold on to it for 4 years. So here you are, you hold it 1 year, 2 years, 3 years, 4 years. I have no idea why this pen does that. So after you've held it for 4 years, you sell it to someone else. So the price that you sell it for, the bond market is a competitive market. And the price that you sell it for is the price that that person buys it for, which sort of feels obvious, but people don't put that together in this problem. So what you need to think about is at time 4, this person is buying, they're going to receive $10,000 6 years later. So they are buying $10,000 6 years in the future, and for them, their yield to maturity is 3%. So what you're doing is establishing the price. So what you sell it for is the competitive market price in the market. And the competitive market price in the market is the price at which somebody else is going to buy, receiving $10,000 6 years later with a 3% yield to maturity, because interest rates in the market have changed to 3%. So you're going to get 2 different prices. You're going to get a price at time 0. You're going to get a price at time 4. And then the question is, what was your rate of return on this investment? So now we're just solving for R. We have a present value at time 0, a future value at time 4, and you want to know what the R is. The second problem is pretty straightforward, but the first problem helps to kind of think through what's going on. So when you figure them out, go ahead and put answers. Go ahead and put answers in the chat box. So my reason for doing this was mostly to focus on that first one, but this is an old slide and it had 2 problems on it, so I gave you both. So what I'm going to do is I'm going to go through the mechanics of what these calculations are, and then go back to what I was talking about at the beginning. So let me clean up the timeline, get all the little people off of it, and deal with the calculations. So I think most of you got this first number from what I could see, but just to make sure everybody knows, it's ridiculous, knows where it comes from. You have a future value of 10,000. N is 10. I is 8. And you solve for the present value. Now, when you sell this bond 4 years later, it's trading in the market at a competitive market price. And the price that it's trading at is based on the interest rates at that point in the market. And at that point, the interest rates in the market are 3%. So the price that somebody is going to pay for it is going to be based on the present value for the buyer of receiving $10,000 6 years later. 6 years later, because there's 6 years between year 4 and year 10. So the price at this point is going to be based on future value of 10,000. N at this point is 6. I is 3. And you solve for the present value. And you get 837484. So now what you have is you invested. And at this point, when you're looking for the return on your investment, it doesn't really matter what you invested at, what you invested in. You could have invested in a motorcycle and sold it 4 years later. So what you have is a timeline where you invested 4632, I'm rounding, at time 0, and 4 years later, you received 8375. So your inputs for that are present value, 4632, that's a P. Future value, 8375. N is 4, and you solve for I. And you get 15.96. So the second one, the inputs are listed there. So it's asking you for the yield to maturity. It's a semi-annual bond. So it looks like a lot of you ended up with that 5.64 number. A couple of you initially had the 6-month interest, had 2.82, and you just need to multiply that by 2. So when you do this and you solve for I, you get 2.82. You multiply that by 2 to get the annual rate, and you get 5.64. So the 80 payment, you have an 8% coupon. You multiply that times 2,000, and it's semi-annual, so you divide it by 2. So there's going to be another problem like this coupon bond problem, which is literally the same problem. It's just different numbers when we come to the practice problems at the end of class. All right, onward. Get our actual slide deck set up here. So today is our second day of bonds, and next week we start stock. So what we look at today is, now that you did the nuts and bolts on Tuesday, what we spend today doing is looking at things like what happens when interest rates change? How do different bonds behave when interest rates change? What happens when interest rates don't change, but we've just gotten closer to the maturity of the bond? So we're going to look at all of those scenarios and get better at understanding how bonds behave. The last thing we'll do is look at corporate bonds. So what we did on Tuesday was focused on risk-free bonds, because what we were looking at was, if you know that this is going to be your cash flow, what would you pay for it today? In some cases, we're not dealing with default-free bonds. What we're dealing with is companies that issue bonds, and they have different levels of risk. So if there's more risk, people expect a higher level of return. So what we'll be doing at the end is looking at this concept of credit risk and learning how to calculate the prices when there's this added risk factor in there. Okay, so last class, what we looked at was those two bonds at the end, and the two calculations that I had you walk through were, gave you a price of 1038.32, and I had you calculate the yield to maturity, and you got 252. Then the interest rate increased to 4%, and the price fell to 925.03. So interest rates increased and the price dropped in order to bring the yield into line with competitive rates. So again, the price is what changes the yield to maturity. So there's an inverse correlation between these things. So if we look at a given bond, so just say nothing's changed, even if we're the exact same point in time in the life of this bond, if the yield to maturity goes up, the price is going to go down. If the yield to maturity goes down, the price is going to go up. And again, what we're looking at is an inverse correlation, that when interest rates fall, prices go up. When interest rates rise, prices go down. And you'll see this a lot when you're looking at things in the news that are talking about, bond prices fell. Well, when it says bond prices fell, it's because interest rates are going up. When the Fed does something to decrease interest rates, bond prices generally go up. So when you quote these things in the market, like at bond traders, it doesn't really matter if they give you the price or the yield. As long as you have the other information about the bond, if they give you the yield, you know the price. If they give you the price, you know the yield. Generally, what happens is that bonds are quoted in yields. And the reason for that is that then it doesn't really matter whether it's a $100 bond or a $10,000 bond. The yield is still going to be the same thing. If they do quote it as a price, if you go look up bond tables in the Wall Street Journal or somewhere, what they're going to do is the convention is that they get quoted per $100 of face value. So if you had a $1,000 bond that was selling for $980, it would get quoted as 98 because it would be quoted based on 100. So if we think about, so one of the things we talked about, let me go back to that first slide for a moment. One of the things I talked about on Tuesday was that when we had, so this particular bond had a 3% coupon. So when we have a yield to maturity that's below the coupon rate, the price is above the face value. When we have a yield to maturity that's above the coupon rate, the price is below face value. So we're going to kind of look at that big picture now. So what happens is that if you are getting, so let's think about this for a moment. Let's imagine that you have a $100 bond and you have a 3% coupon. If the yield to maturity is 3%, then you can pay $100 for this bond because the 3% coupon is going to give you exactly a 3% return. If your coupon isn't big enough to give you the required yield to maturity, you need to get part of your yield from an increase in the amount of cash that you receive. The face value has to be higher than the price. So if the coupon rate is lower than the yield to maturity, the bond price is going to be below the face value. We call that trading as a discount, trading below par, because then the fact that you're going to receive more at maturity than you're paying for the bond is going to supplement what you're getting from your coupon. On the other hand, if the coupon rate is greater than the yield to maturity, now you're getting a return that's higher. If you paid $100 for that $100 bond, you would be getting a return that's above what the market expects. And think about what's going to happen in a competitive market. If you're getting too high of a return, people are going to rush in and buy that bond. And what's going to happen is that because people try to buy it, the price is going to go up. Think about supply and demand. The price is going to go up. As the price goes up, the yield's going to go down. And that's going to keep happening until the yield gets to the market yield. So what will happen is, if the coupon rate is above the yield to maturity, it's going to trade at a premium. The price is going to be above the face value. Zero coupon bonds are always going to trade at a discount. So again, in this class, we are assuming that interest rates are always positive. I understand that we've been living in a world where that's not necessarily what happens sometimes with the way governments are handling financial panics, but that is way beyond the scope of this class. So for this class, interest rates are positive. Even if they're only 0.001, they are positive. So if your coupon is 0, that is always going to be, a coupon rate of 0 is always going to be below the yield to maturity. So it's always going to trade at a discount. So generally what happens is, when these bonds are first issued, they get issued so that the coupon rate is really close to whatever the yield to maturity is in the market. So these bonds are trading pretty close to par. The reason you end up with bonds where the coupon rate is really different from the yield to maturity is that many bonds are 20 and 30-year bonds. So if it's a 30-year bond, this could be a bond that we could be buying a bond in the market today that was issued 20 years ago. If you remember when we talked about yield curves on Tuesday, and we showed you those graphs for 2006, 2007, 2008, the interest rates were really different at those different points in time. So the bonds are, the prices are going to change a lot to cope with the fact that these interest rates are going to be very different than what they were when they were first issued. So what happens is that the market price, as market interest rates change over a period of 20 or 30 years, the price of the bond is going to be constantly varying. So what we're going to do is we're going to play around with this concept of a premium and a discount. So we're going to take 3 30-year bonds. They have annual coupons, so you don't have to make any semi-annual adjustments here. One of them has a 10% coupon. One of them has a 5% coupon. One of them has a 3% coupon. The yield to maturity is 5%. So the first thing we're going to do is use the chat box to go through the 3 bonds in this middle bullet. Which premium is going to trade, which coupon is going to trade at a premium? So type that into the chat box. Good. 10%. 10% will be a premium. Which one is going to trade at a discount? %3. And the really hard question here, which one is going to trade at par? Yay. Now you're typing quick. All right. So I'm going to have you calculate the prices of these bonds, but before you take out your calculator, for the 5% coupon, what's the price? Excellent. All right. Calculate the price. So this is 30 years, $100 face value, 5% yield to maturity. Calculate the price for the 10% coupon and the 3% coupon and put them in the chat box. So one of the things that's happening as we go through class today is that hopefully you're getting better and better at doing coupon, at getting all the coupon bond information into your calculators. So really sort of treat this as learning a language. Every single time we do a problem today, just be very conscious of it becoming more and more automatic. That's where you want to be at the end of class today. All right, here's your calculations. I think you all got those numbers, but I'll give you a moment to check. Okay. So just to review this big picture here, we basically have 4 takeaways today. So this is our first one, is understanding about bonds that trade at premium, bonds that trade at a discount, bonds that trade at par. So if the price is greater than the face value, what that's called is trading above par or trading at a premium. And we keep using this word trading. What's happening is that these are investments. This is a bond market. This is a competitive market. People are trading these things. And it happens when the coupon rate is above the yield to maturity. If the price is less than the face value, we call it below par. We call it trading at a discount. And it happens when the coupon rate is below the yield to maturity. And finally, If the price is exactly equal to the face value, we call it trading at par, and it happens when the coupon rate is equal to the yield to maturity. All right, that's the end of piece 1. We're going to do piece 2, and then we'll have a break in the middle of class. So the second thing that we're going to look at is the effect of time. And just to be clear what we're talking about here, what we're saying is even if the yield to maturity stays exactly the same. So let's imagine that we had a 30-year bond and somehow the world got completely frozen for those 30 years and the competitive market yield to maturity stayed at exactly 5%. Bond prices would still change. So if you think about it from an equation perspective, the price equals the amount that you're going to get divided by 1 plus r to the n. Well, as we get closer and closer to maturity, the years left are getting smaller and smaller. N is changing. So what we're going to start with is looking at this zero coupon bond, just because it's simpler and it's simpler to see the point, and then we'll reiterate it for those coupon bonds. So we're going to start with the zero coupon bond, and with the zero coupon bond, the only cash flow that you're going to get is that face value. So if we're going to get a $100 face value bond, I'll even put the $100 in there. As n gets smaller and smaller, we're going to have an inverse relationship between the price and n. So as n gets smaller, the price is going to go up. As we get closer to 30, our price is going up. So the other thing that we're going to take a look at here, we're going to do a variation on that first problem that I did with you at the very beginning of class. So for purposes of these calculations, we're going to assume that the face value is $100. So what you're going to do is everyone calculate the price of this bond when it first gets issued at time 0. And put it in the chat box. We're doing the zero coupon bond. Good. So we have a price when we first buy this bond of $23.14. Now let's imagine that we hold it for 5 years and sell it. So we're doing the same thing that we did with that first bond at the very beginning of class. So what's the price if we sell it at year 5 when we have 25 years left on the bond? Good. All right. So the last thing you're going to do here with these two numbers is you invested 2314. 5 years later, you received 2953. What was the return on your investment? Whoops, come back here. Good, 5%. I'm going to go over where all the numbers came from. And then we're going to kind of talk about what this means. But the key point to take away here is that even though we're looking at a curve here where this price is getting higher and higher, what just happened is we bought it here, we sold it here, and we got a 5% return. And what I can tell you is that you could buy and sell it anywhere along this line. And if the yield to maturity stayed at 5% for the entire time, your return anywhere on this line would be 5%. So what's happening is that the change in price along this line, in this case, the two that we did from 2314 to 2953, is purely a function of the fact that you have less years left before you receive that $100 at maturity. So the fact there's less years left means that you're going to get a higher price, but that relationship between those two numbers is going to continue to be 5%. So just to quickly put in the inputs here. So for the first one, price at time 0, you have 30 years left. Your future value is 100. I is 5. So you solve for present value and you get 2314. For the price at time 5, you have 25 years left. Future value is still 100. I is still 5. And you get 2953. So I'm going to talk a little bit about these two coupon rate things. What I want to tell you briefly before I talk about them is that the next two slides go through this calculation. Whoa, why is my computer developing a mind of its own? I'm not even touching my mouse. There we go. So these next two slides basically go through the process of walking you through what we just did. So we bought it for 2314. And then we said, okay, if interest rates stay at 5%, what would we get for a return on our investment? So we sell it 5 years later for 29.53, and the return on our investment is 5%. And the point is that when the yield to maturity stayed the same, the return on our investment was 5%. So when you go back and look at this, the slides will help you walk through what I did. And the takeaway from it, and then I'm going to go back and talk about the coupon bonds. The takeaway from it is that what happens as we get closer to maturity is that the price gets closer and closer. If it's a zero coupon bond, the price is going to get higher, and the discount is going to get smaller because there's less time to maturity. So if a bond's yield to maturity doesn't change, the rate of return on the investment is going to equal the yield to maturity, even if you sell the bond early. So what we're going to do, I'm going to go back and I'm going to talk about the two coupon bonds. But what we're going to, then I'm going to give you a break so that we don't mush too much of this information together. But what we're going to look at after we take the break is, okay, well, what happens if those interest rates do change? Which is what you saw when we did that first problem today. So I'm going to go back to this slide, and I'm actually going to use the fact that there's all those zigzag lines to do that problem that a few of you asked about from my finance lab before we take a break. So the short answer is that the same thing applies to coupon bonds. So from a big picture perspective, and I'll talk about details in a moment, from a big picture perspective, this 3% coupon bond that's trading at a discount, the discount gets less and less. We get closer to our price gets closer to the face value as we get closer to year 30. For a 10% coupon, the premium gets less and less. And at a 5% coupon, it's just going to trade at par the whole time. The reason that we use the zero coupon bond to talk about this is that there's an element here that you absolutely do not need to know for this course. But don't forget, you have like finance professors writing these textbooks. So they're going to pick the one that's technically true. One of the things that happens if you have a coupon bond is your part of your return on your investment is getting that coupon. So in order to get a 5% return on your investment, you actually have to reinvest the coupon and still get a 5% return on that. Given the fact that the yields are staying at 5%, that's actually going to happen, but it's having you all go through the process and show that it works is a much more complicated analysis that would be confusing. So we do it with the zero coupon bond because there's no coupon to deal with. So the other thing that I'm going to show you here is what in the world do these little zigzaggy lines mean? This picture looks kind of like a baleen whale or something. And what's happening here is that so this is an annual coupon. So if you counted the number of little zigzags in 5 years, you would get 1, 2, 3, 4, 5. So each of those little points is one of the coupons. And what's happening is that as we get to the point where the coupon is about to get paid, the value of that coupon is basically the entire cash value of that specific little coupon. This is called dirty pricing. So as you get right up to when you're going to get the coupon, the value of the coupon is all of that coupon. It's not discounted. It's right now. The minute that coupon gets paid, the price drops down a little bit because the next coupon is a year away. So the value of, even if those coupons, each one of them is exactly $10, but the value of this coupon right before it gets paid is $10. The value of this next coupon when it's a year away is 10 divided by 1.05. So now the net value of the next coupon is $9.52. So the difference between being right before a coupon and right after a coupon, the value of that next coupon is like 50 cents less than the value of the one that you're about to get. So what happens is that as you get right up to receiving a coupon, the value of the whole bond goes up a little bit, and then it drops again when you're a year away from the next coupon. And that is what my finance lab problem illustrated. So what I'm going to do is I'm going to stop the screen share on this, go back and do that finance lab problem, because that's basically what it was illustrating. And then I'm going to give you a 10-minute break. So let me go find that problem. I think one of you said it was number 4. All right. There we go. Too big. There we go. That ought to be. So immediately after it makes its first coupon payment, what's going to happen is that we had a 10-year bond, and right after it makes its first coupon payment, there's 9 years left. Right? Everybody with me on this? So those of you who put this in, tell me if I'm answering the right questions here. So immediately after the coupon gets paid, there's going to be 9 years left. So what you're going to put into your calculators is $1,000 for the future value, $72 for your payment, 6.2 for your yield to maturity, and right after the first coupon payment, we have 9 left. So we're going to put 9 for N, and we're going to see if I did the problem right. So then what happens? Oops. Aren't there 2 of these? So then the other question is, well, what happens when it's immediately before a coupon payment? So now we're looking at the top of those little spikes on that picture. So immediately before a coupon payment, right before the first coupon payment, we have 10 payments left, but we don't have 10 periods left. We're actually at the end of the first period. So you can either do this. This is basically an annuity problem where the first payment is today. So one way to do it is just to put 10 in for your coupon. They've changed all the numbers on us, so we have to change it. So 78 is the payment. 5.9 is your interest. 1,000 is your future value. So one option is to say that you have 10 payments left, but that's the value of the bond when it's first issued. So you have to multiply it by 1 plus R to bring it forward to year 1. And you get 1207.80. I hope. Yes. The other thing you could do is you could find the value with 9 years left. So put 9 in for your N and get the present value, and then add the value of the coupon that you're about to get. So you would have 1129.80 and add the value of that 78 coupon, and you get 1207.80. So what I'm going to do here, a couple of you saying, can you draw it? I was trying to show it to you where we could enter the answers, but now I'll take a screenshot of it and draw a picture. Trying to do 2 different problems and draw on them. All right, I'm going to change our screen share to. Okay, so what I'm going to do here is I'm going to use these numbers to do it both ways, which isn't actually how the problem was, but that's okay. So what we're going to do is we're going to take this bond right here, $1,000 face value, 7.8 coupons, annual 5.9. So our inputs are going to be that the future value is 1,000, I is 5.9, payment is 78. Those pieces are going to stay the same, and we're going to do this problem as if they'd had us do both of them with the same problem, with the same numbers. So, and I'll actually do 3 versions of it, okay? We're going to say that here is our 10-year bond. We have payments of 78, and we have a future value of 1,000. So the first thing we're going to do is calculate the price at time 0. So the price at time 0, we're going to say that N equals 10. And we're going to get 1140.51 for our price. Then we're going to say, that'll be the first one. For the second one, we're going to say, okay, what is the price at year 1 immediately before we pay the coupon? So what that means is we're still going to get that coupon. So some of you may be beginning to realize that those problems in the practice problems for the midterm, where it said, what's the remaining value of these payments immediately after the year 4 payment? What's the remaining value of these payments immediately before the year 4 payments? That's what this problem is. So here, it's the exact same thing as those problems in the practice exams. The difference is that we're calling this a bond, we're calling them coupons, but it's the same story. So immediately before this payment, what we have is we're getting this $78 plus the remaining 9, and the remaining 9 are a regular annuity. So one way to do that is just to say, let's act as if N equals 9, and then add the $78 that we're getting today. So that would give us 1130. putting the answers in red. 1130 plus 78, which is 1208. And then the last version is, what is the value? I need more writing space. What is the value immediately after we receive that coupon? So if you're buying the bond and the coupon's already been paid, the guy you're buying the bond from got that coupon. You're not going to get it. The only coupons you're going to get are the remaining 9 coupons. So then for you, the value is just those 9 coupons, and it's just that 1130 number that we got. So the reason that, I see there's a couple of questions, I'm going to answer them in a moment. The reason that when we had that slide, this stuff was zigzag is that if we take these 3 numbers, what's happening is at the very beginning, if this was time 1, the price would have been 1130. Up here, right before we get the coupon, it goes up to, sorry, I put the wrong number in there. Right, the very beginning, when there's 10 years left, the price is 1140. We come up here right before we get the coupon, and it's gone up to 1208. And immediately after we get that coupon, it falls down to 1130. And this is trading at a premium because the coupon rate is higher than the yield to maturity. So that's why the price is dropping from 1140 to 1130. So I'm going to answer these questions. So those of you who have questions in the chat box, I'm going to tell you all to take a break, but don't get off to take your break until I answer your question, because once you get, if you get off, it won't let me answer your questions. It'll say that person's not here. So it is 9:32. Be back at 9:45 and turn off your video and take a real break. All right. So you're actually going to work on some problems. So you're still going to get time away from your screen, but I wanted to have you take a real break before we switch topics. Okay, so what we just did, look at our sum up slide again from this one. What we just looked at was the fact that if yield to maturity doesn't change, I'm looking at this red paragraph down at the bottom. If the yield to maturity doesn't change and the rate, so our return on investment is going to stay absolutely the same, but the price is actually going to change unless it's selling at par as we get closer to maturity, because the impact of the discount or the premium is reduced. Now what we're going to do is look at what happens when interest rates change. So as we've said, the effect of time is predictable, but we don't know what's going to happen in the market. We don't know how interest rates are going to change over the 20 to 30 years that this bond may be outstanding. So bonds with different characteristics are going to respond differently to changes in interest rates. And in general, because things can change a lot, when interest rates change, investors tend to see long-term bonds as riskier than short-term bonds. So what we're going to do is explore how this all works. So what I'm going to have you do, and I have put this slide in the in Questrom Tools as a PDF file. So you can either take a picture of this slide with your phone, or you can get on Questrom Tools and get the Class-9. It says Class-9 interest rate in class project, but it's literally this slide. So you can just go into Questrom Tools and get the PDF file, or you can take a picture with your phone. So this is basically where you are going to practice coupon bond calculations. So one of the things, so I'm going to have you do these. You are going to do 12 calculations. I'm going to put you in breakout rooms. But one of the things I want you to think about as you're doing it is that for each one of these bonds, you have got all of the information for you're using $100 as the par value. So you know what your future value is, you know what your payment is, and you know what N is for each one of these bonds. So one of the ways to get good at thinking about how to use your calculators efficiently is to, get back here, is to put those numbers in there and then do the calculations for 4%, 5%, 6% on that bond. All you're doing is changing the interest rate and getting a new present value. These are all annual, so you don't have to adjust the calculations. So I'm going to put you in breakout rooms. I'm going to give you 10 minutes. What you're going to do is you're going to calculate all of those numbers, check them against each other. And then what you're going to do is look at the percentage change of each of those bonds when it goes from 5% to 4% and when it goes from 5% to 6%. And then we're going to talk about what's going on there. So you've got 10 minutes. I will put you in breakout rooms. This Excel spreadsheet is also on Questrom Tools. So we set it up as an Excel spreadsheet so that we can show you how all of this stuff behaves and play around with it a little bit. But it's there where you can play with it as well. But let's start by everybody checking their numbers. So for purposes of this, my big focus here, yes, we can go over percent change. My big focus here for the moment is, did you get the right bond prices? Like as a drill for practicing calculations, did you get them? The way that the percentages are calculated, they're calculated as a change from the 5% price. So if you did them if you looked at 5% relative to 4%, you would have gotten a different number, but don't worry about that. You still would have gotten the same scope. The purpose of, we're going to talk about the percent changes, but if you use the wrong denominator, that's okay. So what we're going to do here is we're going to look at how big these changes are. So if you look just for a moment at these four numbers, they range from 4.32% to 8.67%. And we're going to point out some of the things that are making a difference there. The same thing is happening over here when we go from 5% to 6%. It ranges from 4.09% to 7.85%. So what I'm going to point out to you is that we have two bonds that are 5% maturity, 5-year maturity, and we have 2 bonds that are 10-year maturity. So the first thing we're going to do is kind of look at the difference between a shorter maturity and a longer maturity. So the ones that are a 5-year maturity, those are the ones where the price change was somewhere in the range of 4%. The ones that are a 10-year maturity, those are the ones where the price change is higher. It's 7 or 8%. If I were to change these 10-year maturities to a 20-year maturity, see what just happened? The price change is much bigger. So what you're looking at here is that the longer the maturity, the more the price is going to change. So a part of what's happening here, before we go look at the coupons, a part of what's happening here is that if you go back to thinking about our basic present value equation, the maturity is N. When we have the 5-year maturity, N is 5. When we have a 20-year maturity, N is 20. So having a much bigger maturity, when R changes, it's amplifying the impact of that change much more. So if you have a really long bond and interest rates change, the impact of that change on the present value is amplified if N is big. So if anyone ever played like Crack the Whip or something when you were kids, think about what happened. The farther out somebody is on that rope, or if you ever had a rope swing that went out over a creek, if it was a much longer swing, you could swing much farther out onto the creek. So the longer you've got, the more it's going to vary up and down. The other thing that has an impact, but it has a smaller impact, is the coupon. So if we come back here, and what I'm going to do is I'm going to reorganize this chart to sort it by coupon. There we go. So now what I'm going to do is get rid of all my color coding and look at the coupons. So we have 2 coupons that are 3% and 2 coupons that are 7%. Now, what I'll do for a moment here is I'm going to change the maturities so they're all the same, so we can just isolate the coupons. So if you look at the 2 7% coupons, they're a little bit smaller than the 2 3% coupons. So when you have a bigger coupon, it doesn't change quite as much. The difference is nowhere near as significant as the difference in maturity. The difference in maturity made a huge difference. The difference in coupons makes a little difference, but it does make a difference. So what's happening here with our coupons is that if we look at our timeline, here's our timeline. The biggest payment you're going to get is out here with your face value. Your coupons are little payments. But if you think about my image of having a big long rope, If you have little weights along the rope, it's not going to swing as much. So part of what's happening is by getting a little bit of money earlier on, you're making it so that the bond isn't quite as long a bond. And if the coupon's a little bit bigger, it's pulling in the effective maturity a little bit more. So there's actually something going on here which you will learn more about later on. We're not going to teach it in this course, but there's a concept called duration, which is the weighted average life of the loan, of the bond. So your weighted average is going to be a little bit shorter if your coupon is bigger. It doesn't have anywhere near the impact that the maturity has, but it does impact it a little bit. So this this Excel spreadsheet is there. You all can play with it. You have a My Finance Lab problem for next week, which is going to play around with this a little bit. What I'm going to do is I'm going to switch us back to our slide deck. And what our slide deck is doing here is showing you, whoops, come back here, that we have a maturity effect. The 10-year bonds for the same coupon, the 10-year bond, so here's our 7%, is going to change more than the price. And the coupons for the same maturity, the smaller coupon is going to change more than the bigger coupon. So what we're going to sum up here is that a shorter maturity changes less, it's less volatile. A longer maturity changes more, it's more volatile. A higher coupon has the effect of shortening up your maturity a little bit. So it's going to make it change less. And a smaller coupon doesn't affect the maturity as much, so it's going to change more. So what I'm going to do is have you think for a moment about how would we feel in different interest rate conditions about a bond that doesn't change as much or that changes more. So we're going to look at a situation where you think interest rates are going to increase. And you have a choice of two bonds that you could own. So one of them has a 10-year maturity and a smaller coupon. One of them has a 6-year maturity and a bigger coupon. If interest rates are going to increase, think about it for a moment and put in the chat box which one you would rather have. So basically, if interest rates are going to increase, then your price is going to decrease. You don't want your price to decrease, so you'd kind of rather have the one that's not going to change so much. So the price on B is not going to fall as much. Now, if you were to hold on to the bond until maturity, now, if you don't sell it in the market, you're not going to be impacted by this. If you hold the bond all the way to maturity, then you are going to get all of the cash flows that you expected to get, and your return on investment is going to be whatever it was going to be. So you're not impacted if you hold it to maturity. The reason you're impacted if you sell it early is that now your final future value is whatever the price you sold it at, and that price was impacted by the change in interest rates. If you hold it to maturity, your final cash flow is the face value, and it just is what it is. That's what's in the bond certificate. So summarizing all the stuff that we've been talking about here, what's going to happen is that if you have a bond with $100 face value, here's your face value, as we get closer and closer to maturity, the bond is going to come closer and closer to trading at that face value. As interest rates change, the price is going to go up and down. So our little blue squiggly line here is the price going up and down over this 30-year period because interest rates are changing. But as we get closer to maturity, there's less years left. The amount that it's fluctuating isn't going to be as much. And it's going to fluctuate within a band based on the structure of the bond. So the last thing that we're doing today is talking about corporate bonds. So we put this until the end because we want you to totally understand what's going on with how bonds behave. But a significant part of the bond market is not risk-free bonds. It's bonds that are held by companies that might go bankrupt. They might not pay. They might be Toys R Us or something like that. So when there's a risk that they might not pay, people who buy them are going to expect to get an extra yield in order to cover that risk. So when we think about corporate bonds, one of the things we need to know is how risky are they? And that is where these credit rating agencies come in. So you've heard of Standard & Poor's, you've heard of Moody's. What they do is they look at what is the risk of this bond? What is the risk that they might not pay? In bankruptcy, they may not pay. And if they declare bankruptcy, what is the risk that you won't get any money? So they're booking both at the risk of a company declaring bankruptcy and at, if they declare bankruptcy, what's the chance that you're going to get paid? So they take that analysis and they give it what we call a credit rating. So a AAA is the best rating out there. Anything above a BBB is what's known as investment grade debt. So funds that have to be really good quality, that are only allowed to invest in investment grade debt, those funds have to buy things that are BBB or better. There are bonds that are below that. They get called speculative bonds. They get called junk bonds. They get a higher return. There are people who are good enough investors that they know how to analyze these things and they can make money on these things. There are also bonds that may have started off as better bonds, but the companies got in trouble and they ended up with C and D ratings, which are really pretty terrible. But one of the things to remember about those bonds is that if you buy a bond that has a really bad credit rating, it is already trading at a price where people don't expect to get any money back. So let's imagine that you bought a face value bond that's $100 face value bond, and you paid, let's say, $2 for it. All they'd have to do is pay $2 of the $100 they owe for you to get your price back. So there are funds that trade in what they call distressed debt. And what they're doing is saying, let's put a portfolio together of these really terrible bonds, because maybe a few of them will pay back and we might actually get a good return. So people do invest in this stuff, but you need to know what you're doing. What we're going to focus on is how do you figure out what the return, what the yield to maturity should be if it's not a risk-free bond. So what you do is you look at what we call the credit spread. You look at how much extra yield are investors expecting over the default-free rate in order to buy these bonds. So if we look at this graph right here, this blue one right here, this is our treasuries. Those are the treasuries. It's more legible in the box. That is our risk-free rate. So what that's telling us is that for a 15-year bond, if there's no default risk, the interest rate is going to be 3.2%. And then we're looking at it and saying, okay, if you're a AA, your interest rate is going to be about 4%. So you're going to add about 0.8% to the risk-free rate in order to buy a AA bond. If you're going to buy a BBB bond, we're going to come all the way up here to about 4.75%. So now we've added about 1.5 points for all of this extra risk. So when you're looking at a problem that involves a corporate bond, there's one of two ways these problems get written. And I'm going to walk through one with you, and then we'll put more in the practice problems. So either we just say, you know what, here's the yield. The yield is 5%, do the problem. And then you do the problem exactly the same way you do it if we've given you a default-free yield. The other thing is we sometimes give you problems where we say, here's the treasury yield, and this bond is requiring an additional credit spread for the credit risk of an extra 2 points above the treasury yield. And then you add those two numbers together and you do the problem that way. So here's an example. We're going to do this one together. I'm going to walk through it with you. And then there's some more that we're going to practice that are in the practice problems. So we're going to pretend that our firm, this company we're looking at, has a credit rating of AAA. And these AAA bonds are going to trade for 0.6 higher than the risk-free rate. So we're going to need to find the treasury rate. So again, we use treasuries to get our risk-free rate. We're going to need to find the treasury rate for 10 years and add 0.6 to it. We have a coupon rate of 4%. We know that it's a 10-year bond. It's an annual coupon, so we don't have to make any adjustments. And the face value is 100. So what we're going to do with this problem is figure out what's the yield to maturity, and then you can calculate the price. The other information is already in the form you've gotten used to. So our future value is 100. N is 10. We have a 4% coupon, so our payment is 4. That's all pretty straightforward. You already know how to do that. The new thing is that you need to figure out I. So I is going to be the risk-free rate, so I'll write treasuries plus 0.6. Here's the 0.6. So what we need to do is figure out the treasuries. So we're going to come down to this bullet here and figure out the treasuries. Now, there's an extra little quirk for you in this bullet that's just showing you another kind of problem you could get. If something is issued at par, Think about the relationship between the yield and the coupon rate when things are trading at par. So if it's trading at par, put in the chat, what is the yield if it's trading at par with a coupon rate of 3.65? Good, 3.65. So we're going to say 3.65 plus 0.60, and that's going to give us 4.25. So now you can do the problem. Put all of these numbers into your calculator. Future value 100, N is 10, payment is 4, interest is 4.25. Good. I'm going to go back to that screen I just skipped in a moment, but here's the inputs and here's your answer. So going back to the screen that I just skipped, what this screen does is it walks through what I just did. So as you go back and look at the slides again and say, wait a minute, I don't remember how to do this problem, what this will do is it'll walk you through it. So we have a credit spread of 60 basis points, which means 0.6. So we're going to need to add that to the treasuries. The fact that the treasuries are being issued at par means that the yield to maturity is going to be the same as the coupon rate. So we're going to add 3.65 plus 0.6 is going to give us 4.25. We have the coupon rate. So we can put all of that into our calculators and get $98. So what's happening here is that you are getting a higher yield than the treasuries because there's a what we call a credit spread there. There's an incremental yield that compensates investors for taking a different level of risk. So what we're going to do is I'm going to open up the practice problems. I'm going to go over with you what is in those practice problems, and then I'm going to let you have a choice whether you want to stay online and do them now or whether you want to hold off until you've done my finance lab. Before I switch to the practice problems, for Tuesday, you have 2 assignments due on Tuesday. So I'm going to pull up the syllabus. Give me a second. Make sure everybody focuses on them, knows what they are. It's kind of crazy for you not to get credit for them. So Tuesday is class 10. You have my finance lab due. You also have, when you go into Questrom Tools, you're going to find something called the EPS assignment. Open it up. It'll tell you what to do. Actually, I will open it up and show it to you right now. So you have 2 things due on Tuesday. You get 1 point for each of them. So make sure you get both of your points. Let me stop the share and pull up the assignment so you can see what it looks like. and you're going to submit it to Questrom Tools. There's an assignment that is open now that is set up on Questrom Tools. So when you come into Questrom Tools, you are going to find this thing that says EPS project. When you open up that folder, you will find a Excel spreadsheet. I will open up the spreadsheet and show it to you. It's already on my computer. So what you're going to find is you are going to find this information for two companies. So we have done Cheesecake Factory so that you can see what we're looking for. What you're going to do is you're going to pick two companies. So what this is doing is this is going back to what we did in class 7 when we talked about earnings, we talked about dividends, we talked about payout rates, we talked about retention rates. In the company's 10K, you are going to find all of this information. So you can, if you want to, you can use the Cheesecake Factory 10K to go into it and see what it looked like in that one. So you're going to find the earnings per share. You're going to find the dividend. That's information that the company gives you in the 10K. So then you calculate the payout rate, you calculate the retention rate, and then you go to this link right here, and it will let you go find the stock price at the end of the last 3 years. So you can pick any company you want. What you will discover is that there are, we're now talking about the real world. So unlike the problems that we create for this class, you may find a company that doesn't pay dividends. That's perfectly okay. You just put 0 for the dividend and 0 for the payout rate. You might find a company that had negative earnings and paid a dividend. In that case, just put not applicable for the payout rate. But there are companies that happens because we're talking about the real world now. So what we'll start with on Tuesday is getting an idea of some of the things that you all did. We're going to look at what's the range of things that companies actually do in the real world. Some pay dividends, some don't. Some pay dividends even when they're not making money. So we'll look at the range of all of that so you get a sense of what does the world really look like. So what I'm going to do is pull up so the practice problems for class 9 are available to look at. And again, I'm not going to require everybody to stay online and do them now because I want to make sure you get good use of them. So some of you may decide you'd rather go do my finance lab and get to the point that you feel like you really understand this stuff and then do the problems. Make sure you've done them before next Tuesday, because I want to make sure that if there's any questions out there, we deal with them. So these first ones are just playing around with bond calculations. So what's the yield to maturity? What must the coupon be? This fourth one is exactly the same problem that we did at the end of class today, just different numbers. So see if you've got a better sense of it now. This fifth problem is looking at the whole volatility thing that we did today. And then the second page is 2 corporate bond problems. One of them, we give you the credit spread. So you need to figure out what the default-free rate is by looking at the treasury bonds. And then this particular case, this is a BBB company. So you're going to define that default-free rate and you're going to add 2%. This is a semi-annual bond. So you're going to have to deal with thinking about all of those adjustments there. And then the second problem, we don't give you a credit spread. We just give you, the actual yield for that credit rating. So for this one, you have a AA bond. You just say, oh, the yield is 5%. You've got the yield. The problem, the particular problem we're giving you, because we're not actually making it quite that easy, is saying, okay, play around with this, find the price, and hopeful. So the goal here is we've given you the range of problems that you will eventually see on the practice exam. So we will give you the practice exam for the final exam at the end of class next Thursday. The final exam is on Wednesday, July 1st. So that'll give you a week to work with it. But this set of practice problems right here is giving you the range of bond problems that you're going to encounter so that you have a chance to start thinking about them, start being aware of them. So that's the end of what we need to cover in class today. Again, if anyone wants to work on these right now, stay on. If you've had over 2 hours of bonds and you are completely ready to be done, you are absolutely welcome to get off.